Righty. Again, thank you everyone for joining us. This is the end of 2023 real estate debt fund update. So wanted to, of course, get through all of the legal pieces. If you want to pause your screen or review it, this is just our confidentiality disclaimer and other good legal pieces of information. So make sure you read this and abide by the laws and regulations for that. This is a 506C like Charlie under the SEC Regulation D, open to accredited investors only. So typically an accredited investor is a person with a net worth of $1 million or more, excluding your primary residence, or if you're an individual, you've earned $200,000 in the last 2 years and have a reasonable expectation for that to continue in the future. And if you're married, it's $300,000. If you have any questions about this, reach out to our investor relations team. We're happy to help walk you through that or help you get a verification letter from a third-party provider, or of course a letter. We have some templates or just, required documents for your attorney or a CPA to make sure that you are accredited. This is an institutional quality investment. And again, it's a 506C like Charlie. While we are waiting for Kelly, she will be joining me here as soon as we can get all of our technical difficulties sorted out. But I'll go through our little profile. For those of you that haven't invested in the debt fund before, we call it the debt fund. Borrowers are our customer base, our borrowers call it Rehab Wallet. So if you have a moment, go check out rehabwallet.com. That is our borrower-facing portal where our customers go and submit for new loan requests. And Kelly Garrett here on the screen, she'll be joining us hopefully momentarily if we can get through our technical difficulties. But Kelly has been in the real estate business, gosh, for 30 or 40 years now, has personally flipped more than 200 homes herself, has been a borrower, has been a private lender, has owned a lending business in the past, had an appraisal company, and is just a wealth of knowledge when it comes to private lending, as well as rehabilitating properties, flipping properties, dealing with contractors, subs, all that good stuff. So super beneficial to the team. And like I said, hopefully she'll be joining us. Myself, Danny Randazzo, here in the middle of the screen. I have been working alongside Kelly and Dan in this business since we've started it. I kind of float in between both sides of the business and really in our legal, financial areas, as well as the capital raising side where Dan really fits in and oversees all of that aspect. And of course, the marketing that goes out to our borrowing teams, different events and things like that. So we've got a great team, but the most important thing on this slide is not the three of us at the top. It's all of our team members here that support this business. So I said institutional quality, and that's really our sentiment here. When we operate this business, it's done at an absolute institutional scale and professionalism. We have a managing director, directors of operations, compliance, legal, marketing, finance. From A to Z, we have things covered. And this team is just an absolute rock star team. We've grown it over the last 2 years pretty aggressively to get to where we are today. When we first started out almost 3 years ago, it was really Kelly, Dan, and myself kind of pooling our own personal money together and going out and doing loans to prove the concept. And then we knew what this business could do, both from a borrower side and providing great returns to an investor side. And so we always had that mindset of building this team out and growing it. It's just been such a pleasure to see the team grow and expand as we are going into the 2024 calendar year, we're seeing great demand, continued demand from our borrower base and continued demand from our investor base. And so it's a balancing act that we get the joys of maintaining between loans going out, loans paying off, and new investors coming in and investors needing to get out. So it's just been a real treat to see this team grow, and we are really well set up for good success in 2024 to manage all aspects of the business with the phenomenal team members that we have here on this page, and I get the pleasure of working with on a regular basis. So kudos to our team for being excellent at what they do. Jumping in to the investor side of things and kind of why all of you are here today or rewatching this webinar. We currently offer an 8% preferred return to investors who have $1,000 or $100,000 minimum or more. And then there's a 6% for anyone 25,000 to 99,999 with a 6% preferred return. There is a 90-day liquidity option. And so this is a great balance. When I think about my own personal money invested in here, along with Dan and Kelly, all of us as partners have our own personal money in here. This liquidity 90-day option is really beneficial because it balances out. For me personally, I think about long-term investments like a multifamily syndication or a car wash fund where you have to wait for a capital event to get your money back. This is the opposite of that. This is a short-term component where you have the ability to get access to your capital if you need it. It's a nice feeling to have. If you need to get your money out, you can make a request, and we try our best to fulfill those as quickly as possible. But we kind of have about a 90-day period that we like to plan for. Of course, if you have a special circumstance, reach out. We're happy to help as we can, but it is a balancing act, like I said, of loans going out, loans paying off, new investors coming in, and any withdrawal requests we have. So that is where we're at on the returns. And I'm going to talk about how the fund works. This is usually the Kelly Garrett show here, talking about how the fund works. And then I kind of get to talk about capital protection and things like that. But since we're still having some technical difficulties, hopefully she can join when she has time. But basically, the way the fund works and how we've been successful in this business is, Kelly's experience, my experience, and knowing who these borrowers are in the fix and flip space, in the small single family rental investor area. We want to thoroughly vet borrowers. We want to make sure that their experience, their references, and their ability to pay are of the utmost. Ultimately, we want to provide good loans to great borrowers who borrow the money and pay it off and rinse and repeat. We have had a significant amount of repeat borrowers that borrow money. And it's really nice as a lender, if you've done 3 or 4 loans with this borrower already, you have a high confidence in their ability to pay and then pay you off with their diligent execution of their business plan in buying a property at a discount that needs a lot of work, fixing it up, getting it listed on the market, and then selling it to an end buyer. And that's really the target demographic of our borrower, is someone who's buying a home for a discount, renovating it, and then selling it off. So other things in the fund to make sure that we're doing proper due diligence. We have third-party property valuations and appraisals. We're doing low leverage loans. So that's something we've taken extremely seriously over 2022 and into 2023. And Kelly, thank you for joining us. I'm going to probably rapid fire a couple questions at you to make sure I'm getting things right here on how the fund works. But in terms of leverage, where are we at today in terms of loan to values that we are going up to, and as we look ahead into 2024, just to make sure that we are being conservative from a lender perspective and not lending out too much money to one borrower. What is the current loan to value we're going up to?
I want to make sure you can hear me okay. Can you, Danny?
Gotcha.
All right. Yeah, current LTV right now is at 66.2% loan to value in the 1,253 loans right now we have on the books.
Well, I was expecting a more generic response, but in true Rehab Wallet team fashion, it's spot on to the exact amount. So, you know, as a lender, it makes you feel really good. With the loans we provide being 6 months in duration, it alleviates, and this kind of gets into this capital protection section, it alleviates the volatility to massive real estate price changes. You know, typically in real estate, 3 to 6 months or even 6 to 12 months is a predictable range. It's not like the stock market where real estate prices are changing every single day. And so by being at a 66% leverage amount, it gives us a ton of cushion. If real estate prices pull back by even 10 or 20%, we are still in a first position lien where we are going to get all of our equity back and be able to collect all of our fees. And so that'll be really important. The other big point here, I said we're an institutional quality company. We use institutional quality banking software. We have a great relationship with the software vendor to originate, modify, track, and make sure all of our loans are, you know, properly documented from a legal perspective, an insurance perspective, and from a payment perspective, of course. So that software is imperative to the business that we do. Moving into capital protection. So again, I talked about this low leverage. We do first position liens only. That's a really important component to this business, and it gives a great feeling to me as an investor in the debt fund that in a first position lien, either you pay us back or we're going to take back the property and get our money back that way. So it's a great position to be in. We also have borrowers sign a personal guarantee. So in the event that we have to take something back, we don't collect all of the money that we are due. We can have that personal guarantee to go after other assets or have them come up with the difference to do that. A very important piece here, Kelly mentioned it, we have about 1,250 active loans right now. When you invest in the debt fund, your dollars, once they are placed inside of the fund, are then diversified across every single property that the debt fund holds the first position lien on. And so having one bad loan is not going to jeopardize your investment in the fund. It's going to be diversified across everything in there. Our typical interest rates are averaging around 13%. We're a little bit dated here, but as we've accounted for different movements and different volatilities in the market, we've kind of brought down LTVs to be more conservative, and we have been able to increase interest rates just a little bit, but that's why we are offering an 8% preferred return to any investor with 100K or more in the fund. The preferred return is an important component as well. As you think about the loans that we have on our books, 1,250 or so, we are able to pay out that preferred return to investors every single month because we're collecting monthly interest from every borrower. And our team does a great job to ensure that every single borrower pays every single month for us. And it puts investors in a great position to, number one, make sure their initial capital is protected, but then also make sure that you're getting your monthly interest in that form of a distribution, or if you elect to compound it. I think I kind of really hit on why we like the fund. Maybe Kelly, if there's anything I missed about how the fund worked or capital being protected, you want to chime in, anything that I may have missed there?
Well, again, guys, sorry about the IT issue I'm having right now, but no, our demand is strong. It's something that has been actually since we started the fund back in June of 2020. The strength of the demand has been just not really surprising, but it's been very consistent. And so we're kind of growing to meet this demand by hiring a new sales rep and so forth. But the strength of the demand coming through is very optimistic going into 2024 and 2025.
Yeah. And to that point, over the last, I think, 2 months, we have been able to place capital very quickly. So typically, if an investor is, filling out the PPM, wiring money in, it may take us 2 to 3 weeks to get that capital placed. And then our team emails you saying, hey, congratulations, your capital has been placed in the fund. It is now earning the preferred return starting today and going forward. Right now, and kind of what I would see for the next few months ahead is we should really be able to place that capital within about a 5 to 10 business day time frame. So as Kelly pointed out, there's great demand on that borrower side. We have some really good opportunities that we're seeing from a lender borrower perspective. And so, if you are interested in getting money placed and getting to work quickly, we should be able to do that within maybe 5 to 10 business days. And so something to keep in mind there. Let's see here. Going on, the other important thing, Kelly and I have talked about since we started the fund, since we got this thing going with one loan and one borrower, we have funded, and Kelly, I got to turn this over to you here. Talk to us about this screen here. It's just, it's impressive.
Yeah, this milestone is one that we're very proud of. We just crossed over that $250 million in loans funded. So as you can see, this big number of $251,729,000 in loans funded. We're very, very impressed and honored to be able to put this many loans out with this many borrowers so quickly. The next, I guess, as impressive stat here is the return borrower rate. This means a lot to me. I have flipped myself for almost 3 decades, or excuse me, 2 decades. Been in the lending world for almost 3 decades, and a lot of these return borrowers are using us because of the team and the funds coming in so quickly. So when I was flipping for so long, that was the biggest thing when I would use a hard money lender. How fast can you close? Because usually when I'm marketing direct to sellers, the sellers want to close super fast, and that means a lot. But also little things, other things like inspections for our draws and how fast these draws can come back in our accounts as a flipper. And I think we're doing a really good job, because this stat right here proves we're doing a good job, because 86% of our borrowers come back to us.
Yeah, I think that's one of the things that separates our ability as a lender versus, the borrowers we have. They're professionals. They are highly competent, good credit score type people, pay their bills on time, manage their budgets, get things done. And they could definitely go to a bank and get a loan and pay maybe 9 or 10% interest, but that process is so painful, and it takes, maybe 60 days to go through tax returns and all kinds of effort on the borrower's part, when they can do a loan with us, close very quickly. And a lot of times these kind of distressed sales, as Kelly mentioned, the seller has to sell in a very quick, short period of time, and so it's not an option. And that's why they really like working with us, is just our ability to close and be an asset to their business, not a drain on their time, like, a traditional bank might be in getting a loan with them. So the other big thing, 1,200 and nearly 1,250 almost loans since inception. The huge point I want to make on this page is this lower right hand spot: total defaulted loans. We have 0 deficiencies. We had one loan that we took back from the borrower, put a for sale sign in the ground, and sold it for a profit. All investor equity was retained, all interest, late fees, back owed penalties were retained, and we turned a small profit from that. And so, as we look ahead to 2024, I think with doing $250 million in loans, getting up to 1,500, 2,000 plus loans probably, we will likely have more loans instead of just this tiny 0.00% take back rate. We might have a handful more, but we're going to do our best to make sure that they fall in this recovery column and not in this deficiency column. And the biggest way we're doing that is by having that conservative LTV maximum that we lend to, and making sure, our compliance team is staying all over the loans, the performance, the markets that we're lending in, and really staying on top of the borrowers to understand, hey, you're 2 months in to your project. Where are you at in your renovation? Are you getting ready to sell? So the team does a great job of managing that. And it's probably why we've had a very, very clean and successful default section down here with 1 recovery and 0 deficiencies.
Yeah, I want to jump in for just 1 second on that. Just obviously that deficiency is huge, or that low number of deficiency. I think it's 0.0008% right now. It's actually unfathomable, but we've really been able to do a good job with this, because our objective is not to loan to own. This one default and these one borrowers, we worked tirelessly with them to get caught back up. They tried to get caught back up, they'd catch back up, and then they'd still be late another month and another month. So that's not something we want to do to end up owning a lot of properties. But as Danny mentioned, moving into these the odds of 1,250 loans as of end of 2023, and we move over to 2,000 loans going into 2024, the odds are happening. It will happen. And it's not a concern. It's just the number of loans that we're putting out there. But it also tells us, and it's a metric back to me, as to how good we're doing on the front end. If we originate properly, if we originate correctly, of which I feel like we have the right person in the right seat, we have a 20-year veteran sitting in that seat that underwrites every deal coming into our portfolio. So that's a big shout out to her as to the job that she's doing every day.
Yeah, and I spoke about this, Kelly, while you were getting signed on here, but just, it's not you, myself, and Dan doing things. It's this whole team, and just what a pleasure it's been to see them grow and get to where we are today. So again, we've got the right people in the right positions with the right experience and knowledge to do a tremendous job going forward. With that, Kelly, any closing thoughts? I was kind of reviewing our frequently asked questions, and I feel like I did a good job here in facilitating this update webinar topic without, having Dan or Rob with us just yet. So
you did great.
I talked about the capital being placed. We say here on the screen 4 to 6 weeks. Typically, it's probably been on the very low end of that, of 2 to 4 weeks. But right now, with that borrower demand, we are seeing some ability to place the capital, within 5 business days of receiving it, and a little bit of buffer to maybe 10 business days, just depending on, where we are in the calendar of the month. With that, Kelly, I'm going to ask, one question that I always do to Dan when we're on here, but why as an investor with your own personal money invested in the debt fund, why do you like it, or kind of what gets you excited or feeling good about having that investment?
I guess the main thing for me is that it's collateralized over all these 1,250 deals that we have on the street. It's not collateralized with one loan. A lot of lenders, colleagues of mine, they raise money per deal, and we really didn't want to do it that way. As investors, I wouldn't want it to be done that way because life happens. And things happen. I've obviously been around the block a few years. And so I was part of 2008, 2009, and in the lending business at that time. So I love that part that collateralized over all of the loans as an investor. Obviously, second to that, or as important as that, is that my personal money compounds. And we decided to leave it in there, emergency fund. We leave it in there and let it compound. So we push as many employees, as many people that can, as accredited investors, join our fund so that they can reap some rewards as well and be a big part of this. And many of them do. And that's a big feature on my side too, is the compounding feature of it.
Great. With that, I'm gonna pause and kind of see what kind of questions in here. This a fun question. I'll take this one. Do you get depreciation on your K1? And the answer is yes, you will get a K1. No, there is no depreciation. As an investor, you are only receiving interest income. So based on your personal tax situation, you would likely have taxes due on the interest income you receive, but there's no depreciation, but you could use losses from something else to probably offset, but that's all dependent on you and your CPA and your personal tax situation. What are the fund fees is the question, and there are no fees to this fund. The way we've set it up is really as investors ourselves or investors, and the first dollars that come in to the fund all go to the investors to make sure that their 8% preferred return is paid first. Then, if there's any money left over at the end of that month, we would then use it to pay our team's payroll and salaries and all of those wonderful people you saw on the previous screen. And then if there's money left over after our payroll, our expenses for our software, our computers, our technology, then the manager would keep the remaining profit at the very end. And so it's a phenomenal way that we've set it up where investors are taken care of first, investors get paid first, before even we get to use profits to pay for our team salary and all of that stuff. So that should answer that question. Let me see here.
Hey, let me take this one about controlling defaults. I don't know if you mentioned this, but did you mention about consistent capital and what we decided to do earlier this year?
No, please.
Okay. So one of the situations is, as we were preparing for these number of obviously the number of loans are increasing every single quarter, every single month, is that what happens if we were to have some loans that were kind of just lingering on our books, and we really prefer to get them off our books. And they would linger on our books because they could not refinance us out. Remember, people use us on the Rehab Wallet side. They use us to rehab the loan, purchase the property, rehab it, and then fix and flip it, or refinance us out to hold the property. Well, with some changes in rates, et cetera, what's happened is some of these loans might be staying on our books a little bit longer than this 6 and 9 months that we prefer them to be on our books. So Danny and I had been kind of courting a certain person for a long time, and it worked out early in the year where we partnered with a guy named Whit McCarthy, and Danny, and myself opened up a company called Consistent Capital. And Consistent Capital now is going to be able to take some of these lingering, longer term loans that just will stay on our books, because we lose control once we refer out to somebody to refinance out, a local bank, another Alt-A lender of some sort. So we want to keep control and be able to take the same customer service that we're delivering at Rehab Wallet, and also now put that with Consistent Capital. So we're actually controlling the loan from inception or origination on Rehab Wallet side to the exit. And I think that's going to be a big deal moving forward, with continuing to lower this default rate.
Yeah, I'm not sure how much lower we can get one out of 1,250, but being able to manage it, it's always our vision to, run the business and do things. But first and foremost, we got to protect the assets, and that's investor equity. And so, as we're looking ahead to 2024, we're cautiously optimistic. And I think, the big thing with having that conservative LTV loan amount gives us really good protection of equity in the event that real estate prices come down by 10 or 20%. We are still going to be able to move and sell these assets and retain all of our equity along the way. So that'll be a big one. Let's see here. When you place the minimum investment, if you'd like to add to the original investment, yes. So the minimum to invest is $25,000. If you want to add to that investment at any point in time, I think it's a one-page form from a legal perspective we would send you just to record it. And then we'd be able to add that investment to either your, personal name, if that's what you invest under, or if it's invested through an entity. So it streamlines things to be able to, add 5 or 10,000 here or there. At the same time, if you invest, $100,000, and for whatever reason you need to pull back 50 for a life event, and then in 6 months you're going to add another 200 to it. It's your account. You can kind of add and take away as you need it. We have just a simple form or two to make that as seamless as possible, but also we want to track it and make sure everything is documented legally for that. So it's pretty simple. If you fall below the $100,000 mark, you would be earning 6%. If your account balance is 100,000 or more, you would get that 8% preferred returns. The fund primarily invests in the Southeast US. We have a high concentration of loans where Kelly and I have really deep roots in the greater Charleston, South Carolina MSA. It's a great market, as well as in Columbia, South Carolina too. But we have loans actively in South Carolina, North Carolina, Georgia. Kelly, what states am I missing?
Georgia, we have a small percent in Ohio, only because we have a originator that is from that area. But mostly 71% of the fund is in the Charleston Tri-Counties.
Yeah, and it's a great market to be in. So that's the makeup of the funds. And yes, if you invest, everything is diversified across all of the loans in there. With that, I think we've answered every question that has come through. I really appreciate everyone taking the time to bear with us on our technology issues, listening to me for a little bit longer than I normally speak for. But Kelly, thank you for being here and sharing with us this impressive update that, life to date, $251 million plus in loans originated. About 1,250 loans actively out there. And if you are interested in investing, I would encourage you to, again, follow up quickly. We do have the ability to place funds within probably about 5 to 10 business days, hopefully on the short end of that 5 business days. So with that, thank you, everyone.
Thank you.
Look to sharing a new update with you in the early part of 2024 on the performance and the continued value that we bring to all investors invested in this fund.